This is terrifying. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, a black swan event is about to devastate the U.S. stock market, and I want you to understand why the banks are terrified. It's because they have no control of the situation. And as you're about to see, these dealer banks are carrying all the risk. We'll show you what some of the catalysts could be that could send the stock market unwinding in a way we've never seen before. Plus, we have a sponsor for today's show. We'd like to introduce GRUM Social Enterprises. You can find them on the NASDAQ under the symbol GROM. And let me tell you why you want to look them up, because they are a growing social media platform for children under the age of 13. And when we talk about technical setups like we do on the Sunday show, the RSI and the MACD are coming off oversold territory. The last two times it happened with this stock, it nearly doubled in value. Stay tuned to the end of the show or check out the pinned comment or description below for more information, because we're going to show you a setup where you can make 18 to 23% on this move higher, maybe even more. Now, let's head over to Bloomberg, where we picked today's story up with the headline is zero-day options boom will grow even as some investors fear disaster. And this is that black swan event. What we don't know is the catalyst that could trigger this, but there are a number of events, and we're seeing the beginning phases of this, not only just in the U.S. economy, but all around the world, that could see the U.S. equity markets unwind like we've never seen in history. Equity derivatives with less than 24 hours to expiration, known as zero DTE, have become one of Wall Street's most popular trades as investors, both big and small, seek to navigate the uncertainty over the economy and central bank policy. Trading these options made up a whopping 45% of total option volume from the S&P 500 last year, almost double the level from before the products became widely available in the second quarter of 2022. And so what we're seeing here is not only just retail investors, but we're seeing professional investors in a big way adopt these, to the point where the options market now, if you can imagine this, is bigger than the equity markets. It used to be the other way around. The options market was small compared to the equity market. Today, more people are trading options than ever. And the exchanges are making money hand over fist by allowing daily options. And as you've seen, the volume has gone up because more and more people have access to it. And again, there's no restriction here. Doesn't matter what your level of sophistication, you can trade these, and they're only becoming more prevalent. That's because, again, Wall Street makes money. They make it available. And the scale of the boom has stirred controversy. There are concerns that the activity in ultra short dated options may be affecting stock volatility, while researchers had suggested that retail investors using them mostly lose money because they're betting on the wrong side of the market. And so you start to see why Wall Street wants these in a big way. It's because it's all just a new method to take money from retail investors and transfer it into, of course, the hands of the dealers and the big players. That's what Wall Street was designed to do, as a majority of the survey contributors, this from a Bloomberg survey, showed awareness of the latter risk, with 56% expressing a view that it's too easy to lose money with the tools. But the concerns didn't extend to limiting retail access to zero DTE, with 76 respondents, almost two-thirds who are professional investors, and for good reason. It was only fair to keep them easily available. And of course, when you're a professional team going up against a bunch of rookies, it's easy to take their money, which is why with sponsors like GRUM Social, we give you the edge. And here you can see a great setup that you don't have to worry about, because look at this. You see it's right here on the RSI and the MACD coming off oversold territory. Look at this. The last two times it happened, the stock jumped following that. And here we're seeing the setup. This is that 18 to 23% move we're talking about. Stay tuned to the end of the show for more information. Now, how about this? Both academic and Wall Street researchers have flagged potential dangers with this wave of trading, including that it may make the market more volatile on an intraday basis, and it does. In fact, the largest bank, JP Morgan Chase strategist Marko Kavanovic, has warned their popularity risk reprising past disasters as a 2018 Volmageddon episode, a famous blow-up that shattered a lengthy column in U.S. stocks. The theory here, and this has everything to do with how dealers hedge their books. And this is important to understand because a lot of people right now are crammed into about 7 to 10 U.S. equities. This makes up the bulk of their portfolio. They're very long the market. They have no protection against downside risk, and they're gambling on top of it. But this is the risk that could see things unwind in a big way that no one is seeing. As the theory is that a big stock move could force option dealers who take the other side of trades and must buy and sell shares to keep a market neutral stance to unwind a large amount of their own positions, accelerating any sell-off. So if you can imagine this, some news hit the markets, or maybe we start to slide into a bear market, things start to go wrong. And what are investors going to do? They're going to buy these zero-dated options in a big way on the downside to make a bunch of money. And the dealer banks, who are holding, of course, the inventory of stocks, they have to hedge that, which means they have to end up being sellers. That leads to stocks driving down in a major way. And that's the risk here, that we could see an acceleration of sell-off. That would then trigger machines to sell. And then next thing you know, you have selling begets more selling, and nothing can stop this as investors bet the market going to zero. And the latest expansion, NASDAQ said it plans on more of them. Of course, if the market's making money, particularly Wall Street, on retail investors, well, they're going to make it even easier for you to lose money. As opinions about it, well, they were evenly split in a Bloomberg survey, and asked how they would describe zero DTE. The MLIV Pulse contributors, who are predominantly in US and Europe, well, it wasn't very good. Gambling was the most common phrase offered. A slot machine in Vegas, atom bombs, and tools resulting in a wealth transfer from retail and unsophisticated institutions to exchanges and market makers. And this is what the experts say this is, and yet people can't get enough of it. And yet we come back to, are there catalysts where we could see the US equity markets unwind? And there is a big one, and we started to see that effect last week. Here, let's take a look at, again, the ISM. We look at the US economy, and we know where the economy goes, the market tends to follow. And here we can see both the manufacturing and services sector. Now, remember, everyone said the services sector was going to lead the manufacturing sector at a downturn. We said not a chance. It usually lags that. But look at this. Here you can see the manufacturing sector entering a contraction now. Back in April, what happens? The services sector. Nobody said this would happen, and yet it slipped into a contraction. Then what do we have? New orders on the services sector up a little bit. Manufacturing sector in contraction. But here's the big one. We have the employment sector. You want to talk about what drives the U.S. equity market? I'm going to show you a very interesting relationship here, because what you're seeing is layoffs happening on both the manufacturing and services side. And on the manufacturing side, it's going to get worse. Once these backlogs are unwound, there's nothing left. Well, the layoffs here are going to go up in a big way. And you can see in this chart here, as we look at the Wilshire 5000, this is the total U.S. stock market against continued unemployment claims. And what do you see? A roughly mirror relationship here. What's different now is we've seen an increase in continued claims. The stock market reacted to it like it's supposed to. Then investors bought the dip like crazy, saying, no, this is the big opportunity. If we see continued claims start to tick higher, and based on the data we see now, it's highly likely in the months to come, well, what it suggests is the market likely to head down. And how are investors going to trade that? Well, they're going to gamble on these options, forcing potentially dealers to sell, trigger machine selling, and then you start to see other investors, people who are long the market in their 401ks, retirement IRAs that cannot afford to take big losses, well, they in turn have to sell too. And next thing you know, everybody's selling into a market nobody wants to buy. And we're seeing further evidence of that as we look around the world as China industrial profits drop as demand from overseas stalls. So we look to any case where we see the U.S. economy or the global economy turning around, and we just don't see a whole lot of evidence of that, even as Chinese equities remain in a long-term bear market. As falling factory gate prices have squeezed profit margins and led industrial firms to double down on foreign markets, with domestic demand still weak amid a housing slump. Mounting geopolitical risk could even make that harder, as Western countries now accuse China of building excess capacity in its factories and dumping cheap products abroad. Maybe the issue is China just has excess capacity because the global economy is slowing. So rather than putting people on the unemployment line, well, they're making products and hoping people will buy it. And this is all causing problems. And one place you should look for answers maybe with your trading portfolio is GRUM Social Enterprises. Again, check them out on the NASDAQ on the symbol GROM. Stay tuned. We're going to cover them in more detail later on the show as Maersk sees Red Sea conflict absorbing up to 20% in ship capacity. So we look for reasons why the U.S. equity market could go down, why people may gamble on that. And we see the unemployment market as one of those, as more people are likely to get laid off in the future. We see a slowdown in China validating that. And now we look at Maersk, and this is interesting because the cost now to send ships around the Horn, well, it's going up. And it's not causing energy prices, but there's an interesting relationship between energy and the U.S. equity markets. As we see container spot rates for shipment from China to the Eastern Mediterranean rose 3% last week, the most since the middle of January, indicating capacity shortages could be dragging on longer than expected. Well, that makes sense because we have too much capacity and not enough demand. But here you can see those spot rates are climbing, suggesting the possibility of inflation. But what we're seeing here is not going to lead to inflation the way people think. As Metre told his clients on Monday, that he's using about 40% more fuel per journey when sailing south of Africa, and the charter rates are currently 3 times higher than normal and are often fixed for as long as 5 years. The shipping giant has also leased more than 125,000 additional containers to ease logistics constraints. But the interesting part here is they're using more fuel. But what do we note about oil? Well, oil prices have actually declined. So that's interesting here that we've seen oil prices push up. But what have we noted? The problem with oil is consumers cannot afford higher energy prices. It's leading to less demand, which we see into China. And what does that mean for future earnings? Well, it means companies are going to make less money. When they make less money, it starts to set up stocks going down. But don't hold out because OPEC Plus is likely to extend production cuts because, well, they need the money. And here we can see Saudi Arabia and its allies are likely to keep oil production unchanged for a further 3 months when they meet, of course, on June 1st. And we started talking about energy and the markets, but let's talk about first the relationship between West Texas Intermediate and gas prices. And we can see, where West Texas Intermediate goes, that's the blue line, the gas prices follow. And of course, we know there's a very strong relationship with gas prices and energy, but of course, and being inflation. But one thing I want to note here is you see that energy prices have actually risen faster than gasoline prices. Well, when we see that happen in other instances, as I've highlighted here, what it suggests is the market cannot afford those higher energy prices and that energy prices are coming down and likely in a big way. And again, what did we see investors do? They bought heavy into the energy sector. And when we look at the relationship between energy and, of course, the broad equity market, it makes sense because when the economy is growing, well, we should see demand for energy going up as well. And here we can see investors, as shown in green by the Wilshire 5000, front running the energy market and going long when demand for energy goes down. You can see the relationship here is fairly strong. So as we continue to see oil prices start to head lower, you set up more and more catalysts of what could be a biggest unwind we've ever seen in the history of the U.S. equity markets. The Black Swan event will be what triggers it. And then watch out as everybody starts to sell. And could we see some problems in Europe? Well, we certainly are, but the headlines start to say things are looking better. As we look at the Germany Services PMI, as it's now positive start to the second quarter, as business activity posts the strongest rise for 10 months, but hang tight. It's not as good as the headline looks. And here we can see the backlogs of work are actually helping out, showing a rise in the services sector. And what we also see is that workloads are on the rise and employment increase at a solid and accelerated rate. And that's a good sign, at least from the services side. But again, hang tight because what they noted here is firms linked this primarily to higher wages as operating expenses rose, although there were a number of mentions of an increase in energy prices. Of course, we know consumers cannot afford higher energy prices. They don't have the wage increases to do it. They have too much debt burden. The rate of interest they're paying on their debt is now too high. And here we can see, zooming deep into the report, private sector employment was meanwhile broadly unchanged. So despite hiring in the services side, that means, of course, job losses in the manufacturing sector. And so what happened in Germany, they traded high-paying jobs for low-paying jobs, and that is not a good sign. Maybe in the short term, it causes some bump in services. Of course, as we know, there were likely cost of living increases driving this, but even in France, they see service activity growing for the first time since May 2023. And remember, the mantra was services leads manufacturing. We said it goes the other way. And here we can see French service providers were strongly confident, this is always the case, of the upturn in activity being sustained. But what we know is even though they saw a further cooling of input cost inflation, the sharp increase in operating expenses, although was the slowest in 2.5 years, here's the problem. Wages and energy were noted as the principal drivers of higher costs. And again, that is not sustainable if they do not have demand to match it. And here you can see the increase was the strongest in 3 months as, of course, service providers raised their prices, hoping people will buy it. And what happened here in the U.S., they raised prices and people couldn't afford it. That's happening here in Europe as well. And what this means is, of course, the sector revealed the uptrend was exclusively driven by the services sector. As we look at the manufacturing production fell at a faster rate. Remember, keep in mind, where manufacturing goes, services follow. And even though private sector new orders approached stabilization in April, it was only marginally and the weakest rate in 12 months, while employment growth remained improved, owing to a stalled uptick in services hiring, suggesting this is all about the services sector, which is predominantly lower wage and is not likely to keep the European economy booming. So what this suggests is, as we look around the world, the U.S. economy is slowing down. Chinese economy almost at the verge of recession. Europe hanging on by a thread. All this suggests is we're about to see in the coming months the global economy slide into recession. The black swan event that triggers it, well, we don't know exactly what that is. But we do know investors and retail investors are likely to bet big on the downside, could trigger a flood of selling by the banks as these zero-dated options lead to what would be a devastation of the U.S. stock market. But one thing we're very bullish on, as you saw by the charts earlier, is a sponsor for today's show, GRUM Social Enterprises. You can find them on the NASDAQ under symbol GROM. And again, everything in the pinned comment and description below. And let's check out what they've got going on, because they are a growing social media platform and original content provider of entertainment for children under the age of 13, which provides safe and secure digital environments for kids that can be monitored by their parents or guardians. And one thing that's great about social media platforms is they're a great way for advertisers to reach people. This will give, of course, advertisers a tool to reach younger audiences. Of course, parents will, of course, follow up with their dollars, as GRUM recently working toward a definitive documents phase of acquisition of a Texas-based Arctic 7, a full gaming developer. And this is huge because they are now in a phase where they're going to bring in this gaming development and virtual production services to be offered alongside GRUM's current portfolio of kids and family entertainment, bringing games to, of course, the platform. And in addition, they announced a May release. This is coming this month, of a newly designed COPPA compliant GRUM social app featuring enhanced safety measures for parents and a new interface brimming with fun just for kids. Again, we're talking about potential advertising revenue here for the platform. And what do we see here? This highly anticipated complete redesign of the Children's Online Privacy Protection Act compliant social media app just for kids. This is phenomenal. The new GRUM app will debut on iOS beginning here early this month, with the updated interface for Android users to follow. And this is going to give parents a lot of control over their children's social media. Because despite the challenges posed by the evolving digital landscape, GRUM remains dedicated to creating a safe and enjoyable online environment for children, not just in the U.S., but all over the world, giving parents full confidence in their child's digital experience with GRUM's parent monitoring features, through which parents will have full control of their child's profile and view every post, comment, message, and their friends. And what this is setting up is a huge opportunity in their stock. Again, check them out on the NASDAQ on the symbol GROM. We talked about the tactical setup here. It's coming off of oversold territory. We know that momentum often leads price. And the last two times we saw this, the stock, the first time nearly doubled, the second time more than double. Let's check it out. As we zoom in here to the 30-day chart, what do we see? The supply zone. Buyers clearly defined here as they come in are buying GRUM stock here. This is setting up the initial move of 18 to 23% into the supply zone. If it breaks out, well, it could go a whole lot higher. And what I want to note is you see down here with the RSI, you see momentum continually steadily rising against declining price. How about the MACD? You see it going down here to oversold and move higher, oversold and move higher, oversold and move higher. Momentum is moving up. It's going to likely lead price, which is what we see as we zoom into the 5-day chart. You can clearly see defined here, buyers coming in, putting support under the stock, setting up what could be a potential incredible opportunity for you to realize an 18 to 23% and maybe even larger return. Again, GRUM Social Enterprises, check them out on the NASDAQ under symbol GROM. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.